So thank you everyone for coming. I want to welcome everyone to the afternoon's session, Policy Implementation and Impacts. I'm Andy Fenelon. I'm an associate professor here in the Division of Epidemiology and Community Health at the University of Minnesota. Excited to see lots of new faces and some old faces, and I won't talk too long. I want to give time to our presenters, and I'm going to introduce them at the beginning, tell you a little bit about them, and then I'm going to step back, and we're just going to go in the order of the program. So we have Jane VanHeuvelen. Jane is an assistant professor in the Department of Sociology here at the University of Minnesota Twin Cities, and she's also a member of the Minnesota Population Center and Life Course Center. And her research is broadly focused on the causes and consequences of health and illness and the providers and organizations through which healthcare is administered. Next, we're going to have Sungbin Park. Sungbin Park is a PhD student in public policy at the Schar School of Policy and Government at George Mason University in Virginia. Sungbin's research concentration is applied microeconomics, focusing on labor-related topics. After that, we're going to have Amanda Michaud, who's a senior economist at the Federal Reserve Bank of Minneapolis. She's a macroeconomist who works in the areas of labor, public finance, and international finance. And her former positions include associate professor at Indiana University and senior economist at the White House Council of Economic Advisors. Next, we're going to have Shen. Shen recently completed a PhD in economics at the University of Toronto, and her dissertation exploits historical sources of variation to explore economic and health effects of housing and transportation infrastructure. And she'll be, this fall, an assistant professor at UBC Okanagan. And then last but not least, we're going to have Omer Ali. Omer is a postdoctoral fellow at Duke University and an incoming assistant professor of economics at the University of Pittsburgh. And his research is broadly concerned with political economy of inequality with a focus on racial disparities in the United States. And so we're going to have some great presentations. And first up, I'll welcome Jane.
All right, well, thank you all for being here today. And I'm excited to have a chance to share this paper with you. So we know that place or where you live is a core predictor of health outcomes. And one recent area of attention regarding how place matters for health is policy polarization. Studies in this area find that over the past several decades, states have increasingly passed policies across a wide range of domains that have served to establish more liberal or conservative state-level policy contexts. So for instance, Minnesota and the state I grew up in, Iowa, have recently become increasingly different in the types of policies they have passed. And studies of policy polarization have examined the effects of these diverging state policy trajectories, finding they have significant consequences for health outcomes, and in particular for measures of mortality. Studies in this area have thus largely remained focused on what can be considered endpoints, policies that are passed, and health outcomes. Yet studies of political polarization more broadly have shown that polarization is not limited to the policy level. Rather, studies find political identity has become increasingly important as an organizing logic that informs people's behaviors and actions. For instance, partisan attitudes may inform patterns of consumption or lifestyle-related behaviors, and it therefore seems not only plausible, but has also been documented that individuals may engage in health-related behaviors or based on their political beliefs or attitudes, or as a way of signaling group membership. So we are interested in taking these larger political trends and applying them to studies of partisan polarization. That is, we're specifically interested in examining health behaviors as they represent a key antecedent for health outcomes and one that has become increasingly affiliated with partisan beliefs while also being informed by structural factors such as policies. So in this study, we assess the extent to which political polarization contributes to state-level stratification in health behaviors. And furthermore, we consider the relationship between various dimensions of political polarization and health behaviors, including policies, but also partisan attitudes and legislative control. So we use 20 waves of data from the Center for Disease Control and Prevention Behavioral Risk Factor Surveillance Survey. And the BRFSS is a cross-sectional telephone survey that state health departments conduct monthly with a standardized questionnaire. And we think these data are perfect for our study because they include large state representative samples for a wide range of health behaviors. In all the results that I show today, we include standard sets of individual controls, age, marital status, household characteristics, race, sex, education, income, and employment status, and state controls, poverty rate, GDP per capita, unemployment rate, and demographic characteristics. So in this paper, we examined 3 state-level political polarization characteristics. The first is state policy liberalism, which is a measure constructed by Coffey and Warshaw, and they use a dynamic Bayesian factor and analytic model for mixed data using around 150 state policies to conduct state-by-year policy liberalism scores between the years 1936 and 2020. The bundle of state policies they include, quote, all politically salient state policy outputs on which comparable data are available for at least 5 years. Our second measure, also from Warshaw and Coffey, is mass liberal preference, constructed with a dynamic hierarchical group level item response model, and state year mass opinion data are collected from over 300 domestic policy questions across over 1,000 public opinion survey from around 1.5 million respondents, also between the years 1936 and 2020. And our third measure is Republican state legislative control, which is the average percentage of state Senate and House seats held by Republicans. All right, so these graphs, and I recognize that there is a lot going on, but these figures show state-specific trajectories along our 3 political polarization measures. And we've highlighted 2 states, Mississippi and California, because of their extreme mean values for policies. The dark lines indicate the trend of the aggregate. And the top panel shows the real values, and the bottom panel of values show deviation from state-specific means. All right, so when we look at policy, we see little mean change, but a widening around that mean. California is more left, and Mississippi is more right in 2020 compared to the value in 1985. When we look in the middle at attitudes, we largely see a left movement across states, but many right-leaning states have remained at stable values, while left-leaning states have moved farther left. And when we look at Republican control, we see increase over time. However, the pattern for the specific states we highlight is less clear, and here we see a lot more just heterogeneity. These dimensions are obviously similar, but include key differences that we exploit in our analysis to try to determine what influences health behaviors. So we focus on 9 health behavior indicators or health behavior items consistently available between 1995 and 2021. And we categorize these measures into binary indicators with values of 1 signaling more health negative behaviors. So here we see state-specific mean trends in the 9 health behaviors. And we again highlight California and Mississippi as extreme policy contexts. While there's a lot going on across these different graphs, we are going to just call your attention to a few specific trends. So when we look at obesity rates, we see overall higher levels or much higher levels of obesity. We see lower levels of smoking and a higher uptake of flu shots in the middle. In addition, not always, but frequently, we see Mississippi having worse health behaviors compared to California across a number of different measures, rates of obesity, higher levels of smoking, less exercise, less health promoting diets. And where that pattern doesn't hold is when we look at heavy drinking, doctor visitations, and flu shots, where we see relatively similar levels. So we use linear probability models predicting health behaviors with partisan polarization and controls. We then use model fit statistics to determine whether policy attitudes or party control are better predictors of health behaviors. We begin with a simple comparison across the 3 models with each of the polarization measures added separately. And then we next exploit the differential timing of polarization across these 3 measures, and we'll talk about that more in a moment. All right. So the table shown in this slide visualizes results from 135 regression models, or 5 models fit for each of the 3 polarization measures for each of the 9 outcomes. Red and blue cells indicate the direction of significant polarization associations, while blank cells indicate no significant association. Overall, 96 of the 135 coefficients are significant and suggest right-leaning states have more health negative behaviors. 29 show left-leaning states have more negative health behaviors, and these mostly refer to heavy drinking, flu shots, and doctor visitation. Thus, right-leaning states overall have more health negative behaviors, and the high proportion of significant tests falling in this direction occurs both in models without and with state-fixed effects. Thus, we find more right states and states moving in more right directions associate with more negative health behaviors. Much of the research in this area to date has sensibly focused on policies and end result health outcomes, but we are interested in whether one of these three measures above provides a better set of findings. And so we therefore examine model fit statistics. So here we look at model fit statistics. And we use big statistics and first make simple comparisons across the three models, each with one of the three polarization measures. Our first conclusion is that political attitudes improve model fit above the other partisan measures for 7 of the 9 outcomes. And we have some thoughts about the 2 that don't fit this model that we'd be happy to talk a little bit more about in the Q&A. However, to further interrogate political attitudes, we exploit the differential timing of polarization across the 3 items. So if you look at the differences across states, you see the policy polarization occurred first, with state separation beginning in 1989, and this is before our first BRFSS wave. Attitude polarization lagged to around 2001, and state political control did not begin to polarize until around 2009. So we use the timing of these polarization to fit 9 models using different interactions between polarization measures and time. And we interact each of our 3 polarization measures with a continuous year measure following policy polarization, a linear spline with a knot at 2001 following attitude polarization, and a linear spline with a knot at 2009 following party polarization. Across these models, for 7 of the 9 health outcomes, we find that models interacting attitudes with a spline at 2001 provides the best fit model. And this gives us further evidence that contrary to the importance of policy polarization for health outcomes, it is the bundle of civilian attitudes that predicts the preceding polarization of health behaviors. So we provide 2 examples of attitude polarization change over time. The y-axis indicates year-specific standardized change in the probability of obesity by partisan attitude. And we see that right-leaning association emerged in the late 1990s and has grown consistently since then. Yet there are different ways that attitudes have predicted behavior polarization. And here we are looking at vegetable consumption. So we see that until about 2001, infrequent vegetable consumption was increasingly a left-leaning health behavior. But since then, the association shrank and then switched so that by around 2010, right-leaning states had more infrequent vegetable consumption than left-leaning states. And these findings show that polarization specifically organized around civilian logics have increasingly bundled health behaviors into partisan logics. So scholars of policy polarization have documented the way partisan policy contexts operate as a fundamental structuring factor for health outcomes in the United States. Our findings build upon this research by underscoring that partisan polarization does not operate through policies alone, but instead operates through multiple pathways, including attitudes and partisan power. And we think our findings include a challenge to studies that focus on a direct response to policies, showing that individuals are also responsive in based on their attitudes and their behaviors as well. Thank you.
Hi. It is a great pleasure to present a paper. This is joint work with Dr. Kyung from World Bank and Dr. Earle from George Mason University. To begin with, we can review this job search theory, which suggests that reservation wages goes with UI benefit, unemployment insurance benefit level, and it delays reemployment. However, the reservation wage is not only decided by unemployment insurance level. Working conditions matter, and also especially during pandemic, people were concerned about safety, and we still are. So we derived 2 research questions from this. During a pandemic, does UI prolong unemployment? And secondly, if so, does it have any other consequences? In order to answer these two questions, we exploit the policy variation happened in the summer of 2021. During that time, federal government expanded the unemployment insurance a lot in terms of scope, length, and amount. And all these programs ended in September 2021, but states could opt off early. And 19 states terminated this policies by early July 2021. So the treatment period of our study is from July to August. As you can see in this map, the states colored in red are the states that ended early, the pandemic UI program early, and states colored in blue are the ones that continued until September. So we wanted to see the individual level of decision-making, so we use IPUMS CPS, and thanks to your work, they have longitudinally linked data, so we could identify unemployment to employment transition. So we are not using 4th and 8th months in sample because we don't observe their next month employment status. So using this, we construct rolling 2-month panel. We also link the IPUMS CPS with other data sources, mostly to control state-level covariates and to collect COVID outcome variables. So we focus on the period from February to August 2021 because giving extra $300 FPUC program re-began in late December 2020. So the recipient will have their transition in February. So that's from February to August, 7 months. And we excluded 5 states mostly because they have different timings of terminating these programs. Except for Louisiana, they terminated all these programs at once, but in late July. So their treatment period was captured in August sample, so we excluded that. We focus on experienced unemployed people aged between 20 and 64 and civilian. That gives us sample size of 10,200 observations. So what we want to do first is to construct the difference in differences. The dependent variable we are interested in is unemployment to employment transition. If it's 1, if unemployed person turns employed, and 0 otherwise. And PUI end refers to the states that had ended this pandemic UI program early and also during July and August. We also control for various individual characteristics and state level covariates that might be endogenous to the UE transition decision. For example, job opening rate is controlled in order to control the job market situation in the state. This is 2-way fixed effect method, so we control state and time fixed effect. In some specifications, instead of using industry and occupation fixed effect, we control predicted log wage. And in order to get that, we use the previous CPS surveys when people are not hit by the COVID shock. And also, because our sample period is such a volatile period, we were thinking of having a seasonal adjustment of UE transition. So for each stage, we get the mean level of UE transition for calendar months like February, January to December. Another important variable we are interested in is unemployment insurance benefit level, but unfortunately we could not get that information. So we assumed that state UI replacement rate is the average is about 50%, and we added extra $300 for the people who get FPUC. And in order to do that, we had to control anti-log the predicted wage, and there was distribution issues, so we used the smearing estimator. So this is the descriptive statistics. in all states, in all periods, the UE transition average is 24%. And as you can see here, treated states, UE transition rate jumps a lot in the post period in July and August compared to control states. So this is the basic story. I can end here, but as long as time allows, I would like to demonstrate more. Another interesting part to look at is the unemployment duration. It has higher, control states has higher unemployment duration in weeks, and vaccination rate is also higher in control states. So this is the regression result of the impact of pandemic UI and on UE transitions. We tried many specifications and many different sample periods, and the estimates are consistently and very robustly around 0.1. We also looked at the event study, and we allow to look at the after post period. And as you can see, there is no pre-trend before the baseline period. And there are these 2 months standout, July and August. And then it immediately converges back in September when all states ended pandemic UI. Now we turn to the duration and UI benefit analysis. Let's recall the descriptive statistics. The duration was much higher in the control states. It suggests that it might be endogenous, and the UI duration, UI unemployment duration, UE transition, unemployment insurance benefit level, they are all endogenous. Therefore, we need to find an exogenous variation, and we are using this policy change. So we run the first stage using the policy change. The PUIN is the instrument, and we look at the change in the logo of unemployment insurance benefit. Using that information, we look at 3 different outcomes: UE transition, hazard, and also duration, which directly taken care of the censoring issue. The censored normal regression is type of copy model. And these are the results. As you can see, first stage is very strong. And I would like to focus on the fourth model. Duration benefit elasticity is estimated at 1. So it's quite amazing, and it lies within the range of previous US estimates, but towards the high end. Now we turn our gear to the COVID outcomes. COVID outcomes, the mortality cases, hospitalizations, they are measured at, they are observed at state level. And we wanted to use this individual level labor market decisions. So we had to think of the stage 0. Using the IPUMS CPS, we run a regression, and we in additional to individual characteristics, we add state by month fixed effect in there. And this estimate delta will be a mean UE transition for each state by time where individual characteristics are taken care of. So we call it UE at state level. And we run the first stage as we saw before, this difference in difference estimation. And amazingly, the estimation is around 0.1, like we saw before, even in the state level. And using that information, we look at the COVID outcomes. And we had to think about it. It's not instantaneous impact. People go back to work, they bring COVID, people take time to get contagious and get sick and even get fatal. So we allow 3 distributed lag include and additional to the instantaneous impact. There are many results, but I wanted to show you this picture. This is a cumulative impact of PUIN on COVID outcomes. And as you can see, in case hospitalizations and 2 different sources of COVID death, the impact peaks at 2 months lag, with 2 months lag. And for cases, the difference between treated and control states diminishes quite quickly, but less for the hospitalization and for some source of death, it almost flattens. Compared to the mean level of COVID death in the control state during the treatment period, which was 0.005% per population, our point estimates suggest that that's more than quadrupled. This is another piece of evidence that showing the lags of the COVID death. And as you can see here in July and August, so that's the line after the red vertical line, July and August death rise, and it doesn't stop there. It rises one more time due to the lag. And then it doesn't, unlike the UE transition, it doesn't drop immediately, but it converges back over time. So yeah, due to the time limit, I will let you read the summary, but I would like to conclude with the last sentence. So we found that theoretical models holds even during pandemic. If you get rid of your unemployment insurance, people stay, people go back to re-employment faster and a lot more. But UI policy is not just about moral hazard. Even during the pandemic, we have to think of general health and even people's lives. Thank you.
Hello, so I'm Amanda Michaud. I'm from the Minneapolis Fed, and the views in the talk today are my own. They're not official views of the Minneapolis Fed, the Federal Reserve Bank of Atlanta, or the Federal Reserve System. All right, so we're studying Social Security disability. It's a program that's federal and ensures individuals living in different places with policies that are uniform across place. So for example, the rules of beneficiaries, whose applications are awarded are common across areas. Yet there's large geographic differences in DI take-up. So 7 million Americans live in counties where more than 10% of adults are on DI, and about the same number live in counties where less than 2% of the adults are on DI. The sources of these differences we think may have important welfare implications. So you can think about Itasca County if you're living here in Minnesota. It's a beautiful place up north. It has twice the DI beneficiary rates of where we're standing right now in Hennepin County. It could just be due to need. So maybe there's more prevalence of disability in Itasca County than there is here in Hennepin, or it could be other factors that we think have different welfare consequences. It could be access. Maybe you live further from an office that can help you, or education of the Social Security rules are local. And it could be value. So how far do the benefits go? How much of an impact on your life is receiving disability benefits going to make? If you're living in a high cost of living area, this could be less. If you have other resources available to you, such as family support or other public programs, then receiving disability benefits might have a lower impact. Okay, so here's a map just to set ideas of DI beneficiary rates across the United States. These are data from the Social Security Administration that we have been working with. So we do have some no data areas due to privacy measures, but what you can see here is that there's substantial variation. There are some counties where up to 20% of the working age population are on disability, and some counties where that's down below 3%. I want to emphasize that this is extremely stable across time. So this very dense red area kind of around Appalachia, that's been called the disability belt since the program went into place during the 1950s. Okay, so we can also represent that graph that I just showed you, or the map that I just showed you as a distributional graph. And you can see that basically it's a story of a fat tail towards high disability rates. And this is also true when you look at DI payments of the share of income earned by the working age population. There are some places in the United States where over 15% of all money coming into working age households is actually from the disability program. So what are we going to do in this paper? The first section is going to be empirical. So we're going to examine county differences in DI applications and allowances. And this is our work with Social Security Administration with administrative data for 1996 to 2014. We're going to add to these data from other sources on things that we think are important for understanding the disability application decision. And they're going to be information on earnings, employment, poverty, mortality, housing costs, and medical prices. Then we're going to develop a macroeconomic model of an individual's application choice to understand the role of these place-based features. And we're going to estimate place-based differences in welfare from the disability program. This will be measured as a willingness to pay at age 40. So within our structural model, we can actually ask people or our agents, what premium would you be willing to pay to continue to have access to this program? We're going to separate that premium or willingness to pay into value. So this is how far do those disability benefits go? How much does it change your life? And need. Is it just that some places have more poverty and worse disability in their population than others? Okay. The main data sources we have, so first working with Social Security Disability Research File, we're able to get coverage for over 1,000 counties. There are many counties that are suppressed, but this represents 81% of allowances. And we are able to do some robustness where we fill in the missing counties with state residuals. We're adding to these data, data on mortality at the county level from the National Centers for Health Statistics. Employment and wages are coming from the QCEW. Poverty is from census, as well as population and demographics. Prices are constructed from the BEA and USDA indices, and our medical prices are going to come from the Dartmouth Atlas. Okay, so I realize probably you're all very interested in the microdata, but this is about all I'm going to show you. What we see with all these correlates are the correlations you would expect. As mortality increases, perhaps there's more disability in the population, and that is positively correlated with high DI rates. And the magnitude's pretty significant. You double the mortality risk is associated with almost a quadrupling in the DI rates. And then there's some interesting things. So the replacement rate, the DI program is progressive. It replaced a larger share of income for low income people than high income people. And you kind of get this like tick up at the tail. So in very poor areas, the replacement rate's very high, and that's associated with a disproportional increase in the number of people who claim DI. Okay, so we use a macroeconomic model. It's a structural model. And if you're not familiar with that, real quickly, what we're doing is constrained optimization. So it's a mathematical problem where individuals all get some utility from, in our case, consumption and good health, and they get some disutility from working and from applying for DI. They're constrained by their resources that are available to them, mostly a budget constraint, which is going to say that they can buy goods to consume, they have to pay medical expenditures, and they get income from potential different sources. We're going to use this model to see how an individual's application decision and their welfare value depend on characteristics that are commonly studied in this literature, such as disability, age, and income. And what we're adding is local characteristics such as prices, the allowance process, and other factors. What disability is in this model is it's associated with higher medical costs and lower potential earnings. And we're also including a place-based factor. So the incidence of disability can depend on place. The choices the agents make in the model is whether to apply for disability and whether to work or not. So our view is that preferences, people's risk aversion, how much they value consumption, does not depend on place. And so where disability enters is these two channels. So first, the value of the DI payments can depend on the budget constraint. Expenditures are all nominal. So each place has a different cost of living, a different price level. So the nominal income translates into different levels of consumption, just depending on cost of living where you're at. Medical prices also depend on place and your disability status or extent of disability. And DI covers this if you're on DI. On the income side, there's local labor income, which depends on place and also your extent of disability. The DI payments depend on the local income in the sense that they're progressive. So areas with lower income tend to have higher replacement rates. And then we have this thing, which is the residual, which is, well, what would you do if you didn't get DI? And you can think of that as capturing factors like the availability of food stamps, unemployment insurance availability, and so forth. So then the second components are the need. What does the population look like? So disability processes will depend on place. Poverty risk will also depend on place, which might make the program more attractive. And the probability of allowance depends on place because education often takes place at the state level. And it's subjective because you can't observe somebody's disability exactly. And that could be an important component. Okay, so that was a very quick overview of structural macro. So what drives county differences when we're going to try to map this model to the data? So I said it's not preferences. So it could be that the value for the same individual differs by place. Medical and goods prices, we see them in the data. We can put them directly in the model. The other two residuals we're estimating. So the resources in non-employment are going to be the residual that's necessary to get application rates correct. The DDS process or this education is going to be the differences in the allowance rate conditional on the number of applications. So how stringent are they basically? Now, the distribution of individuals across age and income is observable. We're kind of observing disability. We're doing a map from mortality to disability by going through actually PSID data. But at the end of the day, we can't observe the individual disability of applicants, and the model is going to predict that censored outcome. Okay, so we've estimated the model. I will say that without those residuals, we basically get an R squared of like 0.7. And then we can do these calculations. So the median willingness to pay, what premiums would people pay in order to have access to the program, is about 9.3% tax on consumption. The interquartile range is pretty large. It's between 6 and 12% of consumption. And we can use our model to shut down the different channels that I've been talking about to figure out how much each one contributes to the variance in total allowances and willingness to pay. So in a nutshell, the dispersion in actual disability, like differences in health, accounts for half of allowances, whereas earnings is a much smaller portion. But then when you look at our welfare measure, the willingness to pay, that earnings becomes much more important. So places that are very poor, people with the same health are getting much more benefits from the program. Now we can separate this into value versus need, and very, very quickly, when you move from the 20th percentile upwards, all this variation, this difference in willingness to pay relative to the median is being driven by the actual underlying differences in the population health is what you can think. When you go below 20%, what's happening is people with the same disability that happen to be living in a different place are getting 75% less value from the program because of how much those payments change their life. Either it's high cost of living, they have other resources available, or it's very hard to get on the program. So I think that this is a very important result that, for that very bottom tail of 20% of people, just where they happen to live is giving them a drastically different outcome in how well they're insured by disability, Social Security disability. Okay, so we've done some documentation with restricted data. We have main findings both on just, observed outcomes, how many people are on DI, but, using the structural model, we can say, well, how much is it impacting their lives? How much would they be willing to pay? And then we can break that down into different aspects of the program and use the model to think about how policy changes would change these things, people's well-being and the number of people on DI. Thank you.
Good afternoon, everyone. Thanks for inviting me to present my work on the effects of raising minimum housing standards, evidence from the Tenement House Act. This work is motivated by the fact that there has been a lot of recent research looking at how urban infrastructure affects health outcomes. So, for example, there have been studies looking at the effects of water treatment, the effects of electricity distribution, and the effects of sewer systems. However, even when this type of infrastructure is introduced, it very often doesn't reach the very poorest of residents without regulation. There has been comparatively less literature looking at the relationship between housing regulation or housing standards and health outcomes. And there have been even fewer studies looking at the causal relationship between housing codes and health. The main difficulties in establishing causality are that first, it may be difficult to identify a sudden change in housing code enforcement. And secondly, it may be difficult to match individuals' data to houses and neighborhoods. My contribution in this paper is to show that an increase in housing quality increased survival rates for some residents while displacing the most disadvantaged residents to outlying, less accessible neighborhoods. I established a causality of this relationship by leveraging the abrupt introduction of a Tenement House Act in New York City in 1901. The 1901 Tenement House Act was the first housing quality regulation in the US that was strictly enforced. I assembled a new data set on historical building permits, and I combined that with the complete count US censuses to look at migration and other outcomes at an individual level. I implemented quasi-experimental research design comparing buildings that were submitted before and after the legal permit filing deadline under the Act. My results show that children's survival rates increased by 1.7 percentage points in neighborhoods with a building permit coming under tenement regulation. About half of this neighborhood level effect is due to the causal impact on incumbent residents. And this means that life expectancy is estimated to increase by 2 years for children born in a treated neighborhood. However, the most disadvantaged incumbent residents were displaced to the urban fringe to less accessible neighborhoods. So first, a bit of background. We would expect tenement legislation to have an impact on health outcomes because of prevailing conditions in this period. Poverty was a pervasive fact of working class life in turn of the century in New York. And these two photos show some examples of the dangers of tenement living. In the first photo, we see a group of people crowded into a small room. And so poor ventilation and congestion were risk factors for the spread of tuberculosis, because tuberculosis was spread through respiratory secretions. In the second photo, we can see outhouses where waste is left out in the open until it can be collected by horse and cart. And so the prevalence of these inadequate toilet facilities was pointed out as a main contributor to typhoid fever, because this waste left out in the open got left in contact with houseflies. In the late 1890s, people were beginning to become aware of these channels of disease transmission. And this was partially what led to the 1901 Act. The 1901 Tenement House Act was intended to alleviate the problems of overcrowding and disease in tenement districts. The act required newly built tenements to have one bathroom for each apartment, an outward-facing window in each room, And finally, fireproof construction materials for certain parts of the building. For the first time, a tenement house department was created to enforce these regulations. So a permit would have to be approved by the Bureau of Buildings before construction, and after construction, the regulations were enforced through lawsuits, vacate orders, and semi-annual inspections. However, if a building permit was filed before April 10th of that year, it was exempt from many of the new regulations, and that's what I used for my identification strategy. For my data, I digitized building permits from the New York City Municipal Archives from January 1901 to August 1901. These permits had building classification available as well as the rough location of the permit. So I was able to geocode the buildings with the NYC GeoClient API. For my demographic data, I'm using the 1880 to 1930 complete count US censuses. In these censuses, the locations of households are known up to enumeration district, but the boundaries of these EDs are changing over the years. So to make neighborhoods which are consistent across years, I use a methodology from Schertzer and Walsh 2019 in which I partition Manhattan and Brooklyn into equally sized hexagons. Individual level link data comes from the Census Linking Project. And for this individual level data, addresses will be from the Urban Transition GIS project and geocoded with the NYC GeoClient API. My empirical strategy relies on the idiosyncratic timing of permit applications. So the law was passed April 12, 1901. But after the act passed, it was determined that permits filed before April 10th would be considered pre-existing and would be exempt from many of the new regulations. So because of the date a permit was filed, a building would be subject to additional regulations or it would not be. I compare neighborhoods that had a permit filed just before April 10th, 1901 to neighborhoods that had a permit filed immediately afterwards. So these bin scatter plots show average permit characteristics based on the day permits were filed. In the first bin scatter plot, we can see that the disapproval rate of permits jumps at the cutoff date of April 10th and remains elevated for 4 days afterwards. But in the rest of the plots, we can see that the characteristics of permits are roughly the same in the 4 days before and after the cutoff. So even though these permits were disapproved, they were similar to permits filed before the cutoff with respect to observable dimensions. Based on this, I restrict my sample to permits filed in the 4 days before and after the cutoff. This is showing the geographic distribution of permits in the sample. The crosses represent pre-law permits and the squares represent post-law permits. This is showing that the pre-law and post-law permits are spread throughout upper and lower Manhattan, as well as in some parts of Bronx and Brooklyn. Using this sample, I apply a difference in differences approach to look at the neighborhood level effects of the Tenement House Act. So in the equation, the coefficient of interest is that on the interaction term between the year being after 1901 and the neighborhood containing a post-law permit. So we see that treatment decreases population density in the neighborhood. And in addition, children's survival rate in treated neighborhoods has increased by 1.7 percentage points. That's about 1/5 of the effect of doubling household income. So what were the mechanisms for this neighborhood level improvement in children's health? Is it due to a change in neighborhood composition or due to actual benefits accrued to low-income residents? My research indicates that the act disproportionately displaced low-income residents to more remote areas, and that this had negative effects on the segment of the population the act was meant to protect. So first, at the neighborhood level, treated neighborhoods saw an increase in the proportion of middle-class residents. Secondly, at the individual level, I see that men living in treated neighborhoods in 1900 were less likely to be matched to the 1910 census by the Census Linking Project. Because the matching process is performed using the full census and is based only on name, date of birth, and place of birth, a lower match rate should indicate a higher rate of emigration or death. This difference in match rates is robust to the inclusion of age and other demographic controls. Finally, geocoded observations show that treated workers in lower occupational categories were disproportionately displaced by the law to more remote neighborhoods. Then to measure the direct health effect of the act on incumbent residents, assuming that they did not move away, I make use of the difference in children's ages at the time the act was introduced. The identifying assumption is that while families who move out of treated neighborhoods are different from the families who stayed, their decision to move is independent of the ages of the children. As a proxy for a child surviving, I again look at whether the child was matched to a census record in 1910. But because when a child disappears from the census, it could be due to death or it could be due to emigration out of the country. I also look at a subsample of children who were born in the United States and whose fathers were American citizens. So this is a subsample who is less likely to move out of the country. The gap between the match rates of the treated and control group is growing as age increases. I attribute this to older children in treated stay-at families having less exposure to the new tenements. Based on the difference between the slopes, I estimate that the 10-year survival rate increases by about 0.5 percentage point per year of exposure to treatment, which translates to about a 2-year increase in life expectancy. In addition to the census linking project, I also use the IPUMS multi-generational longitudinal panel to look at individuals linked across censuses. The difference is that the IPUMS MLP uses household level information to link additional women and men. This table shows the effect of treatment on the probability of being linked in the IPUMS MLP. So similar to the census linking project, treatment reduces the probability of being linked, but this effect is smaller because it also includes women, and women are linked based on household level information instead of based on the full census. Also, we can see that there is positive selection along most dimensions. Because of this positive selection, I use a Heckman selection model to look at the effect of treatment on occupational scores and survival rates in the IPUMS MLP. Treated men saw decreases in their occupational score compared to control. Meanwhile, in the second column, treated women saw increases in the survival rate of their children, which is consistent with the neighborhood level results shown earlier. Finally, in the third column, I restrict the sample to a subsample of mothers who are living in a household where the household size is at least one more than the number of surviving children. So this is meant to focus in on a set of households where children are more likely to be living with their mothers in the same neighborhood at the time of the census. And we can see that the increase in survival rate is slightly larger for this subsample. So in conclusion, in this paper, I demonstrate that an improvement in housing conditions has a positive causal impact on child mortality. Also, I find evidence that the 1901 Tenement House Act displaced low-income and foreign-born incumbents to more remote areas of the city, which had negative consequences for their employment prospects. Thanks.
Hi, everyone. My name is Omar. Today, I'm going to talk to you about my project, which studies the impact of the Federal Housing Administration on racial disparities. First, let's start with some motivation for this project. The first point I want to talk about is that the racial wealth gap is one of the largest disparities that we measure. The median white household in the United States has roughly 10 times the wealth of the median Black household. And that this gap may lie at the core of racial disparities. So a lot of us here study racial inequality in health outcomes and maybe education in sort of neighborhoods where people end up. And you can think of the racial wealth gap as potentially upstream of those outcomes. So understanding where this disparity comes from might actually help us understand where these other disparities come from as well. And for families outside of the top 10% in the US, housing accounts for the largest share of wealth, and homeownership is generally how households in the US build wealth. And sort of in the mid 1930s, this government program called the Federal Housing Administration began insuring mortgages to facilitate home ownership, basically shifting the United States from a society where the majority of people were renters to the kind of society that we live in today, where a majority of households are homeowners. But that this program disproportionately served white households. So that's what I'm going to study. I'll give you an overview of what I do. So the research question that I try to get at is what the effect of this mortgage insurance program was on racial disparities in housing outcomes. My main findings are that although the program was primarily a home ownership program, I find a negligible effect on the FHA's impact on the racial disparity in home ownership. But I find that it had an expansionary effect on the racial disparity in home values. And this was surprising to me. So I look into what the mechanism might be to reconcile these two findings. And what I arrive at is that the FHA actually accelerated white suburbanization, leaving Black homeowners in central cities, where the value of the properties that they acquired actually declined. So first, let me give you an overview of the Federal Housing Administration. So this is a government agency, was founded in 1934. It expanded the access to the low down payment, low interest rate amortized mortgage that we are used to today, which is payable over a longer period of time. Before the FHA sort of came onto the scene, I would say the majority of mortgages in the US were really short. So you had to repay within 5 years. And they had crazy down payments, like 50% or something like that. So the FHA sort of made it much more accessible, made homeownership much more accessible by making it possible to repay mortgages over a longer period of time. And sort of, what we arrived at today is sort of the 30-year mortgage. You can think of that as an outgrowth of that sort of introduction by the FHA. It was a large program. So it started in 1934. By 1940, it was insuring about 150,000 mortgages per year. And that it served about a third of all new housing and a quarter of all residential mortgages by the 1940s. And white households accounted for just the vast majority of these mortgages. And why are these insured mortgages? Why are they, valuable, or why did people like them? Well, basically, this meant that you could afford, for the same down payment, for the same income, you could afford a much more valuable property, and it could actually affect your sort of extensive margin into home ownership as well. So the data that I use to study the impact of this program primarily comes from the full count census. So I look at home values and home ownership between 1930 and 1940. I also use the linked census, so the census linking project, to look at household relocation. For the treatment variable, I use the cumulative value of all FHA insured mortgages by county between 1935 and 1939. This is the best data that we currently have available. The Federal Housing Administration has notoriously bad records. We think that they destroyed their archives in, I think, the 1960s, when they faced lawsuits alleging racial discrimination in the program. And so unlike a lot of the New Deal agencies that we have really great records for, they have, like pretty much nothing that they've actually preserved. But luckily, another government program had audited a bunch of the New Deal agencies, and this is where this data comes from. So this is, it's great, but it's great that it exists. Of course, it would be great if we had more granular data, lower than the county, but this is what we have right now. But where the FHA was insuring mortgages is endogenous. So if we just use the value of FHA insured mortgages as a treatment variable, we might be assigning other things to it that are sort of just endogenous to where it was doing its insurance. And so as a sort of attempt to address that, I used the distance from each county to the FHA field office that had jurisdiction over applications from county residents. And I use that as an instrumental variable. The idea here is that if a county is closer to an FHA field office, it's just more likely that more applications are submitted than that these applications are successful. The FHA, before approving applications for mortgage insurance, especially on new construction, had to have compliance inspections. So staff from the FHA had to visit the site, sometimes multiple times. And that process, sort of sending documents back and forth, as well as visiting the site of the new construction, was just much more likely to be completed successfully if the county is closer to the field office. And field offices were actually, they had very well-defined jurisdictions, and they ran along county lines. So each US county had one field office that was responsible for applications from its residents. And for control variables, I use county as well as individual level demographic and economic controls, also from the census. So the estimation strategy that I use is a triple difference in differences with a continuous treatment. What I'm effectively doing is I'm comparing white versus black outcomes before versus after the treatment period in counties with relatively more versus relatively less FHA insurance activity. So let me just jump into the main results real quick. Oh, sorry, this is the first stage. So this is basically showing that the distance from the local field office is important for the value of FHA insured mortgages, right? So what I want here is I want the coefficient to be negative and significant. What this shows is that the further you are from the local field office, the less likely as a county you are to be treated. I use FHA per capita. So I take the cumulative value of FHA insurance in this period, 1935 to 1939, divided by the county population. I could use other measures as well. So I could use, I could scale it by the value of the housing stock. The results don't change. The coefficients change a little bit, but the results don't change. So here, this slide is basically just to show that distance from FHA field office is actually important for whether or not a county is treated. So these are the main results. So for the home ownership column, you can see that the coefficient is pretty small. The way to interpret this coefficient is if it's negative, it means that the FHA expanded racial disparities in home ownership. If it's positive, it means that the FHA program sort of drew black and white outcomes closer together. For home ownership, the coefficient is pretty small and it disappears when I use my instrument. Whereas for home values, it remains negative. And this is actually pretty robust to a bunch of different specifications that I could use where I cluster at different levels and include county fixed effects as well. These results were surprising given that the FHA program was primarily a home ownership program. It allowed working class families to aspire to home ownership for the first time. And so I was really expecting to see that home ownership here, that there would be racial disparities in home ownership. So the mechanism that I've sort of settled on to reconcile these two findings is that what the FHA did is that it sort of accelerated white suburbanization. Here I use a measure from the census that sort of is one if a household is in the central city of the metropolitan area in 1930 and is in the suburb of that metropolitan area by 1940. So that's what the suburbanization measure is, how it's constructed. And here I split the sample between white and black households. And as you can see, so this is just the IV coefficient for the white sample, right? In counties where the FHA was more active, white households were more likely to suburbanize during this period, and black families were less likely to suburbanize. So, so now you can think of, okay, well, what happened to these folks who moved to the suburbs by 1940? And now I'm looking at, again, white families and white households and black households who are both in the suburbs by 1940, and what happens to their home ownership rates. So the confidence intervals for the black coefficient are really large because there aren't that many black families in the suburbs in this period. But for white families, you can see that they're much more likely to be homeowners, conditional on moving to the suburbs by 1940. The opposite is true for households that remain in central cities. So these are households that did not suburbanize during this period. And what you can see is that actually Black families are more likely to be homeowners, conditional on remaining in central cities, right? And the opposite is true for white families. And next, I look at what happens to suburban versus central city home values, right? So here I'm not splitting the sample by race. Instead, I'm splitting the sample by whether the address is in central city or in the suburbs. And you can see that the FHA sort of in counties where the FHA was more active, suburban homes increased in value, central city homes declined in value. And so that reconciles the gap that emerges in home values, whereas you can think of Black and white families becoming homeowners in different places. And so their home ownership rates are moving in parallel. Okay, so I think I'm within time. So just in summary, FHA mortgage insurance had a negligible effect on the racial disparity in home ownership by 1940, and it had an expansionary effect on racial disparities in home values, and that this is likely because the program accelerated white suburbanization. The contributions that this paper makes is that it estimates the effect of the most important home ownership program on racial inequality, and it identifies an institutional source of racial disparities in home values, namely federal housing policy. It also expands the literature on redlining by focusing on the FHA instead of the Homeowners Loan Corporation, which maybe many of us are familiar with, sort of made these residential security maps. I think that's it. Thank you.